Welcome to the M&A Healthcare Insights Podcast, focused on identifying transactional truths for those who care. This episode is part of a series to identify the key members of a transactional team. Our firm was recently elevated from an M&A advisory firm to now a higher standard as an investment bank. And with that, we wanted to share insights and considerations from experts who we collaborate with as we enter into an M&A process. And with that, it's my great privilege to introduce a friend and someone who we've leaned on over the years with his expertise, Mark Romano. He's the Vice President of Mergers and Acquisitions at Simitree Clinical Consultants. And, we're here to talk about M&A. We're here to talk about healthcare. And Mark, please, love to hear about you, about the firm, and get into a conversation, about how we can help people in this crazy market these days.
Crazy indeed. Thanks, Andre. Thanks for the introduction. As Andre said, I'm Mark Romano, Vice President over Mergers and Acquisitions here at Simitree. I've been with Simitree. I've had the pleasure of being with Simitree for, I think this year is going to be my 20th year. So I've been with Simitree and in the industry, the post-acute, home health, hospice, personal care service industry for the better part of, I think, going on 2 decades now, which sounds crazy to say. Simitree ourselves, product of 2 companies coming together, Simeone and Blacktree, and having, I'd say, over 50 or 60 years of experience in this industry. So we've been doing it a long time. One stop, what I would call a full service consulting firm, from recruiting to outsource revenue cycle to mergers and acquisitions and professional services. I've been kind of worked every little spot there. I'm finance background, worked every spot. Kind of landed in M&A about 10 years ago and been running ever since. I primarily oversee our financial due diligences, but I also kind of manage the whole group, which includes our clinical operational due diligence as well as the financial due diligence. So I'm very excited to be here and chat with you a little bit about our experiences in M&A, especially over the last few years.
Yeah, no, it's been a whirlwind, huh? I mean, it's like we had all that sort of pre-COVID, scare about what was going to happen with the value-based modeling and PDGM, and then, and everyone, thinking that was the big deal, and then, obviously 2020 hit, and boom, market shifted. But oddly enough, for our world, it actually created it created an uptick in deals, but then there were a lot of delays at the time. So a lot of that got pushed into 2022, which was a record year, 2021, 2022, right? Record year. But then it softened quite a bit in the last 18 months, I'd say. And so, I think one of the things that you touched on was that, you brought Simeone and Blacktree together, which, prior to, when did that merger happen? Or in that
2021. So I think we had our 3-year anniversary about a month ago. So yeah.
Okay. Wow. Yeah. That was a great union, right? Because you had great consultation, expertise. Obviously, there was the financial pieces of it, but coming together as far as healthcare goes, it's really given you the ability to have a deep bench of resources, right? And dig in on the businesses.
Yeah, absolutely. Very complementary. As I think everyone on all sides would call it, was very complementary. There wasn't a lot of overlap. I mean, each company, though we saw ourselves as competitors, we really specialized in different areas. And I think bringing those two together, the revenue cycle, the strength in the revenue cycle piece that Blacktree brought, and then the clinical operational and financial piece that Simeone brought together. And then since then, we've kind of added other layers, including data analytics, behavioral. We've kind of we're now consider ourselves not only in post-acute behavioral health as well, bringing in some firms and experts to really help us expand there and really expand and broaden our horizons across the board. So it's been great. Merger and acquisitions is no stranger. I have just in everything that we do, we just have a deeper bench to go to and really make sure we know, keep our finger on the pulse of the industry and the market, and be able to apply that in our diligences.
Where is the area that you apply your experience mostly in the work you do?
So mine is I think I mentioned as financial. So I oversee and participate in a lot of our quality of earnings. So obviously a big part, and we're gonna I'm sure talk about it today. But two big items that always come up in diligence is going to be your financial due diligence and your clinical due diligence. And the financial due diligence is just what it sounds like, a quality of earnings. It's validating the financial statements with which a seller presented to a buyer. A buyer is going to make an offer based on those financial statements, and then they're going to want to confirm what we call confirmatory diligence, right? They're going to want to confirm the accuracy of those financial statements. They want to make sure they're essentially, for all intents and purposes, getting what they're paying for. I oversee that and have been doing that actually for over 10 years, helping M&A even before I was officially a part of the M&A team. But and then, I oversee our clinical due diligence. I oversee that team and just make sure they have what they need. By no means am I a clinician. You wouldn't want me diving into the records, but I can tell you our clinical team is, in my opinion, second to none. They have each individually over 20 to 30 years of experience in home health, hospice, personal care services alone. That's beyond the breadth, nurses, therapists. When we're talking about BCBAs, when we're talking about behavioral health, they have that expertise, primarily usually in a clinical compliance type of compliance regulatory type of role. So they really understand what they're looking at when they're looking in the records.
Yeah, I think your expertise, definitely on the financial side, as we know, you do an exceptional job there, but you also utilize the clinical data as you put together your reporting. And so it's not as if there's any kind of distinction, in my opinion, from when you get a Simitree report. Obviously you've got one that's focused on Q of E, but you also have all of this operational data as to how the business, where the risk factors are, right? Which is you're generating that information collectively.
Yeah, and that's a good point. I think it's something that it has definitely shifted in the market, in the sense that it's not just about revenue and expenses anymore. Buyers are diving into the weeds a little bit more. They want to see KPIs. They want to see your key performance indicators and how you're trending, and how you compare to the market. So even though you might pass with flying colors on the accuracy of revenue and expenses, they want to make sure there's nothing kind of buried in the statistics there that might be, whether it's a strategic buyer that maybe just won't be a mesh for the two companies, or it's a or it's a private equity firm or of the like, where something that scares them, whether it's a concentrated payer mix, or it's I don't know, a high out of network, a high number of out of network payers, those sort of things that can kind of scare a potential investor that there might be significant risk to, or a high something else sticks out when you have all your referrals concentrated into one or two referral sources. There's risk there, and they're diving deeper and deeper pre-acquisition, post LOI, pre-acquisition, to make sure they really know what they're getting. And it's been amazing watching it really develop from just kind of a focus on financials to just a holistic look at the provider in financial diligence.
Yeah, no, it's pretty grueling from our perspective, though. At times you sort of get this, all this information. We represent clients, in the lower middle market, right, the smaller to mid-sized business category, and a lot of our clients are always looking and going, why do they need all this information? And then, what is all this? Why all this reporting? I mean, what do you usually? How do you respond to that when you're working with clients? Because you work with not only with clients on the buy side, right?
Yeah.
Looking at whether it's a worthy transaction, doing sort of accretive, dilutive analysis for buyers, but then you're also working with clients on the sell side
Yeah,
and
yeah,
identifying, their strong points.
yeah, and I can tell you from a sell side, it's a lot. It's all about, and I'm sure you would echo this, Andre. It's about telling a story. It's great that you have strong financials and that everything kind of proved out, whether you're doing buy side or sell side diligence. But the statistics and providing all those levels of detail tell a story, and a lot of times that story adds additional value, or at least validates the current value. Right there, there's just so much unknown when you're just looking at some financials, that those statistics are imperative, both sides, both to tell a story on the sell side, but also to validate, you just general sense of what you're buying for the buy side. And I can tell you, on the lower middle market, I completely understand that is a huge burden. Diligence can be a big burden on a seller when they're running the day to day, and a lot of times they're wearing multiple hats. And I mean, we try to, as an agency, and with the experience that we have in the industry, I mean, I can guarantee you, I've been into almost. I say almost because I always get one that pops up that I couldn't believe I didn't know about, but almost every EMR, electronic medical record system out there. We've been into almost every single one. And
Right.
what we try to do is we try to leverage that experience and say, hey, listen, if you can give us access, or you can let us, or we can send you a list of the exact reports we need, that's going to take the burden off you. You don't have to go looking for PDGM statistics, because we know where to run. We know where to find them in in an EMR, whether it's a WellSky or a NetSmart or a Home Care Home Base, right? So we know where we're looking, and we find that helps a lot on these smaller transactions with a overburdened owner, is trying to alleviate a lot of that stress and responsibility.
How do you encourage your clients who are looking to sell their business, or preparing for a process? How do you encourage them to take the step of going through financial analysis, or going through clinical and charting analysis?
Well, I think for probably lead with, listen, you don't know what you don't know, and you want to level set your expectations. You don't want to put yourself in a company through a diligence just to have it fall apart because something was found, or something didn't quite line up with what we thought it was, and it changes the deal structure. But then, and you're set as a seller, you're set on whether it's a number or whatever it might be. You're set on a certain direction, and that course changes. So you really, you want to get ahead of anything that might come up, whether it's, if you're a cash based company, I can guarantee you any financial due diligence is going to convert you to accrual base. And, that can have an impact on your financial statements, depending on the trajectory of your company, whether you're growing or maybe you're declining a little bit. Converting to accrual can drastically change your financial outcomes, and so and then that could change potentially the structure of the deal, the offer. It could certainly change the offer if they're going based on some sort of EBITDA offering, multiple of EBITDA. And on the clinical side as well, if you don't, if there's something, I mean, you want to know from a best practice perspective anyways, if there's something missing in those clinical records. And it happens to every agency out there. Sometimes it's just a change in document. One example I use that we still see to this day was a change in the election of benefits form for hospice. And I think it was 2020. They changed the verbiage. They I'm not clinical by any means, but I know they added or changed how that should read. And a lot of companies just didn't make those changes.
Right.
For a long time, in diligence, we kind of put it as I would liken it to a warning, right? Like, hey, listen, this is a risk. This, if Medicare wanted to, they could pull back. This isn't correct, technically isn't correct, and they could, but we're not seeing it. We're not seeing them kind of ding providers for this reason. And that all changed about a year ago. We saw, about a year ago, I would say, payers and the payers woke up a little bit and decided they wanted to start auditing. After that nice audit vacation of COVID, where a lot of ADRs and post payment reviews and that sort of stuff were paused. They came out swinging, and they came out and really began diving into company records, and that's one thing that we noticed was starting to get dinged was that simple change in verbiage. So that knowing that, understanding that, and being able to get ahead of that, again, that's what we use to kind of convince an agency like this is why it's important. It's important to get ahead of that, to level set your expectations. And if there's anything that is wrong, get ahead of it. Start making corrections before a buyer comes in and finds it. Because at least if the buyer still finds it and still has those findings, you can come back and show them where you've improved. And that is always going to go a long way with the buyer, is showing them this is what we've done. We found it. We identified it a few months ago. These are the changes we put in place. Please take a look at records in the last 3 months, and you'll see a noticeable difference. Those sort of things can really change the course of a deal. Whereas if a buyer comes in and you present and I can't tell you how many times I heard it, is we are great with documentation. Everything, all of our I's are dotted, all of our T's are crossed. Everything's perfect. You're not going to find anything. And we find something. I would be a rich man if I had a dime for every time I've heard that, right? Yes.
That's, I mean, yeah, that's
and that's if you present that front and then a buyer comes in and finds it, it can do one of two things. They're going to drastically alter the deal, change the deal, which if you've had your mindset on a specific, number, that could potentially derail things, or they might walk away, if it just seems too risky. So it's important to get ahead of those things and know what they're going to uncover, because you can level set your expectations in the deal, and you can also get ahead of anything they find and kind of help them get a little bit more comfortable that you've identified it and you've made those changes.
Yeah, no, I liken it to very difficult to read the label on the bottle when you're inside, and you really want that group to come in and do the assessments, but then also bridge the gap between what's happening in that regulatory environment. What are the healthcare laws currently? Let's look at some audit chains and things that are happening that we're exposed to, so that we can help you to avoid that as you go into a process, right? I mean, I think it's just good maintenance. I mean, you get your car in for a tune-up, twice a year. It's like you really should have someone come in, and an expert like yourself come in and look at the business. And look, even if you're a healthcare business, and we don't expect you to have CFO audit level books and records, but there has to be accuracy within those books and records, and we have to be confident that we're not going to expose those, and the buyer is going to come back and see something. And I think too, that for our mantras, right, are like, uncertainty kills valuations, and time kills deals, right? And this is a way of removing uncertainty, and it's a way of expediting the process, because if the buyer feels comfortable that the analysis you're presenting is bona fide, it's validated, then they're not that they're going to pull back on their efforts to move forward, but they're going to have the data that they need to do their own analysis. And that can take quite a bit of time, just aggregating information into our data room and sharing it, and then normalizing it, right, in a way that they can interpret it and do their own analysis. So I think the value is immense. And we've actually been working now with clients where we give them an incentive to do this type of analysis before we go to market. Clearly for us, like, we want to get out there and we want to move, but we give them an incentive to say, look, use a group like Simitree to go out there and clean these aspects of the business up. And just look, you're an expert. We trust that everything that's happening in the business is on the up and up. We know that, but it always helps to bring someone in and have an accountability partner that can come in and make sure that these items in the business are completely primed. So
Yeah,
I think it's great.
I agree. And that's what I would caveat to is we the things we find, the issues, the risk, the billing risk that we find. I would say 99% of the time, at least in the years that I can remember, are not fraudulent. They're not done purposely. They're not
Mm-hmm.
done intentionally. These are just, we're a highly regulated market, and those regulations, they not only can they be vague and cumbersome, but they can change, and it's just you miss one change and that potentially, that just, it's not intentional, it's not uh, at all, but it's just understanding that it's there and making change. I liken. I mean, you don't even have to call it a sell side if you don't want to. I liken, at least from a clinical diligence perspective, it's a compliance review. You're just
Yeah.
reviewing, your compliance, the effectiveness of any compliance program that you have, and just it's like a tune-up, right? So it can be an annual thing too, just to make sure you're on the right page. Um, yeah. So
No, that's great. Well, look, Mark, I think that it speaks to the importance of bringing in, a financial expert, in healthcare, and a clinical expert as well that can come in and go through and do these reviews and get us ready for the market. All good things there. Let's transition a little bit. So, as I mentioned in the intro, we've moved from being what would traditionally be considered an M&A advisor, right, where our focus was almost solely on the LBO market, right, where we're with financial buyers or buyouts, right, per se. And so we felt like we should be more in an investment banking capacity where, look, at the end of the day, what we do is we get capital. We can take capital from one person, we give it to another, right? Like that's kind of what we're moving. And, the way that we've done this has been through a sell side M&A process. And usually that entails a majority buyout. And there can be certain aspects to the price consideration, which aren't all cash, but that's sort of the structure of what we do. Now we're going into the realm of being compliant as an investment bank, which means that we're registered with the SEC and their regulatory body, which is FINRA. And what we wanted to do there was really be able to provide services to our clients that would be fulsome in scope. So we could have minority interest sales. We can go and help them with their debt needs. We can help to work through them on their, from a consultation perspective in terms of their operational and financial structures. There's a lot of more that we're afforded now that we're in compliance. Now it's not easy because there's this regulatory board that's overseeing us and all that, but we felt it was important as we elevated the standard of the firm to head into that direction. I'd love to get your opinion on that move and sort of how you work with the people in our capacity on these transactions.
yeah, no, absolutely. I honestly, I can give you perspective from both sides, right? I think it's the right move. To your point, it kind of broadens the horizons, allows you to do a little bit more for your clients. Maybe not a little bit more, a lot more for your clients. Um, and I can tell you, just in an experience of working side by side from a sell side perspective with the dealer broker, and working on the, I don't want to call them opposite sides because it's all the same goal, but working on the buy side of a seller who's represented, I can tell you just by experience, things move. You don't have a lot of those surprises aren't there that we discussed. Some of those, diligence, and that's because of who you're working with. A team like Andre and his team, and your team, Andre. You guys you've seen it all, and it specifically in this market. So you kind of know, you know, without diving into the weeds too much, where there's potential for, I don't want to make it this grim, but where the bodies are buried, right? So you know where to look and where to say, hey, let's have a look here, and let's get ahead of this, and kind of that prep work that's really needed. I mean, there's a lot of sellers out there who just don't know what they're getting into. They know they want to sell, whether they want to retire, whether they want to cash out, or just want to get out of the market, whatever it might be. They don't know what they're getting into with a transaction, and that causes friction with buyers, and that can sometimes kill deals. Is you don't know what you're getting into. They don't understand why to everything, and they end up just overwhelmed and potentially killing the deal. Where when you're represented, that's a big part of your job, Andre, right? Is to kind of prep them for this, get them ready, get them the best deal that they can get, but also make sure they have all their ducks in a row for the buyer. And that's what we find. We find just much more organization from a buy. If I'm a buy side and I'm coming in, I can tell you a lot of times what we do is we have a priority list, right? These are the priority items: financial statements, bank statements, billed and paid claims, things that help us get clinical and financial diligence off the ground running. And a lot of times that has to wait for a kickoff call. And then after the kickoff call, we request those items, and time moves on. And we find a lot of times when it's a represented seller, that stuff is there. We have a kickoff call, we're given access to a data room, and the majority of what I would call priority items are there and help us just get going. And it really expedites processes. And being that point person, Andre, speaking from experience of working with you, is you being that point person, making sure we have what we need from the buy side, and that when there are issues, when something's missing, when something's taking longer than expected, you're getting ahead of it and helping us expedite that. I see that as one of the largest values, at least from my experience. And then on the sell side, obviously, that's where you're all, the broker dealer is like I said, just getting, aligning everything, aligning expectations with, and I like what you're doing here about the kind of offering incentives to do some sort of diligence, financial analysis, and compliance, or whatever you want to call it, clinical due diligence, compliance review, whatever you want to call it. I think that's, and to be honest with you, I see that in the direction a lot of, not just brokers, but a lot of people are pushing sell side. It's important. It's important, especially in this day and age. I think it probably stems from those spikes in 2021 and 2022. Valuations were so high that now it's like trying to level set a little bit more, and everyone now is just a little bit more uneasy in deals, and want to make sure they're really doing their diligence, and you need to be prepared for that. I think the broker dealer is a perfect way, not just to get you the best deal, but to be prepared.
Yeah, no, it's interesting how there's been so much activity, but also there's kind of been a general sort of erosion of trust in between counterparties, right? And the type of buyer now that we're seeing more of a prevalence in is the strategic buyer. And it's interesting. I guess these things flow in waves, right? I mean, well before COVID, I'd say back in 2015, 16, we tended to see, I don't know, I guess it was like 50-50 strategics to financial buyers, right? And by strategics, I mean, for our viewers, it's someone that's operating a larger company operating in the same healthcare segment that you are. So it's sort of to vertically integrate your company is easy for them to do and benefit from some of the reduction in overhead and whatnot. The financial buyer is more the portfolio builder, the private equity group, those investors that are coming in that have to get returns, and they look at deals quite differently, right, Mark? And I think when you're working with an advisor, we have to understand, okay, who are we going out to in the market right now? Where are the eyeballs, right? And again, in pre-COVID, well before COVID, I'd say it was about 50-50, and then it really started to become much more private equity focused with a lot of consolidations going on, particularly in these healthcare services segments that we represent. And now I've seen in the last 18 months it go where the strategics are ahead of it, and they're probably looking at deals because they've got free cash flow, and so they're gonna buy more heavily with cash and not leverage the deal as much as a strategic would, or excuse me, as a financial would, because of the cost of capital. And so as you start to get into these deals now, when you come to that, and when we come to it collectively, as financial experts, and then as also experts in healthcare, we can start to say, okay, well, these buyers are going to really need this information, and we're going to need to be solid as it comes to this type of analysis for them. And I mean, I like working with strategics. I like working with private equities too. I think they've been fantastic, especially the way that they've been buying with experts. Usually they'll bring in someone that's been doing it, or one of the companies that they've consolidated. They've got the operator at the table with them, so they know exactly what they're talking about when they're talking to our clients. But the strategic is, coming from the perspective of, speed. I think, once they decide they want to move forward with it, they take a little bit of time, but once they decide they want to move forward with it, I have the feeling that they move quicker, because they just understand fundamentally the business more. And so, but anyway, in any case, like us being experts in that, I think has been a real benefit to us. And now this next level of expertise, I think it really speaks to the potential risks, right? Because we talked earlier how there's the deal world is changed, right? It's volatile right now, and there's a lot of folks that are dropping out of transactions, and maybe we can talk about that a little bit right now, just to, why is that happening, and how do we avoid that? But one thing for sure is that like a deal has risk factors, so does your representation, right? And so for us, we felt like, hey, we want to mitigate the risk factor of you going into market with representation that isn't in compliance. And so we didn't want to have any doubts as to, can we represent this company in a securities transaction and with this kind of structure to it? So we wanted to get that off the table completely. So when we're talking to the attorneys, or when we're talking to folks like yourself, that's not an issue. But as we look at this market, what can we do to avoid these deals from sort of dropping out? Because that seems to be the issue, which I haven't seen it in my career, where they tend to you tend to get kind of deeper into diligence than you have before, and and it falls through. What do you think is happening there, and how do we avoid it?
Well, I think I think you see two sides. Is I think a more cautious buyer, like we said, they're looking at more. It's not as simple as, is my revenue what they say it is? Is my EBITDA what they say it is? Well, just talking financial, is there, what's the risk levels look like on the clinical? It's just a more cautious buyer, really making sure this is the right fit. If it's strategic, to your point, they do a lot of times. We do see, to your point, they do a lot of their own diligence. They do their own some finance, but we see a lot more strategics, we're seeing a lot more really getting into the weeds pre-acquisition. During that, between that post LOI during the diligence, they're getting into it more. They're really involving their operators so they understand the type of company that they're looking at. They're really trying to pro forma things that you would expect to happen kind of post deal. Hey, we bought this great company, everything checked out. Let's see what this looks like together. Is they want that picture before it can go forward, and they need approval from their operators. And so it's definitely a more careful buyer. I think with those longer diligences, you mentioned it earlier, time kills all deals, right? And so I think sometimes drawing out, and this goes for predominantly for a seller who's not represented, is there going to be things are going to the way information's delivered, the accuracy of that information being delivered, it takes longer. And again, it might not even be the buyer being picky. It's just, in diligence, it can, hey, you sent me these financials, but some of them are run accrual, some of them are cash. Can you rerun them? And it takes 2 days to get a response on that. And then, oh, hey, you ran these wrong. Just not having that organization and not having that guiding hand, like from yourself, Andre, that just expands and just creates longer diligence processes. And there's just significantly a higher risk that a deal doesn't go through the longer it takes. On that side, on the sell side, I truly think, and I think you're on the right path where it's expectations. It's not knowing what you don't know. And so you go into a situation, you assume diligence is a formality, right? And and then it comes out, well, hey, this is your clinical risk, or hey, your revenue is way off, and that's a direct hit to EBITDA, and we've got to retrade. And then all of a sudden, no, this is, you got sellers saying, hey, this is what I expected to get, this is what I think I'm worth, not having that, that expert like yourself, Andre, to say, hey, like, listen, and first and foremost, it should come out before you go to market. You should know predominantly what's going to get found, how it's going to get leveraged against you. And that's putting a cynical approach on it, that every buyer is looking to leverage something against a seller. That's not true. I mean, I've had strategic planners saying, hey, we want to pay you more because that means EBITDA is higher. And that means, we're getting more EBITDA, right? So we want this to work out. We're not trying to nickel and dime you on this deal, but these are just true things that we're finding that, that create a risk to us, or it's a lower EBITDA than what you presented to us. And that's why we need to retrade. So it's not all cynical in that every buyer is looking to reduce the purchase price. But it's just the nature of the process. And if a buyer is bidding based on what they assume, based on what you submit to them, and what you submit to them is, for lack of a better word, wrong, that is, that's going to cause these retrades. And on the seller side, if they're not prepped for that, then that can kill a deal. I mean, to that point. So we see it on both ways. We see it just a deal killing because there's, something we have seen an uptick in is a lot of the lower middle markets. There's higher risk in the clinical audits, and that's just the nature of it, right? A lot of them so small, you don't have a dedicated compliance program or a compliance, person, and so it's hard to keep up on regulations. This is, like I said, it's a tough market, and it's hard to keep up on regulations, and that's where we see a little bit higher risk flushing out in clinical that has caused, some an uptick in deals dying. Certainly a big area.
Yeah, I think also the activity has declined too a little bit, right? Because the sellers also are taking the cue that, well, there's uncertainties in the market. There could be systemic downturns, and I feel like, something I've been thinking of recently is that, for years it's been, that real estate is a hedge against inflation. And in my opinion, it's sort of like an operating business is a hedge against inflation. I mean, unfortunately, a lot of the folks we deal with are, caught in these reimbursement contracts where they're definitely not pegged to that increase, that loss of buying power in the dollar, but they still have ways of generating income or increasing their revenue. And look, it gets passed through to the customer or the patient, but the point is that they can operate more safely in these markets with a business, and that the cash out, they're thinking, it's probably going to be a little better if I wait, right? If I wait a little bit. But there is a category of client that we're working with quite a bit now that, because of the declining reimbursements, because of I should say, the reimbursements not keeping up anywhere near where inflation has been in recent years, and then also just other top-down pressure. We do have a category of a client that constantly says to us, "Well, how come that they don't see the value in my business in all these other operational components? I've got this incredible management team, or I've got I've got this patient base, or I've got this contract, right? Or my physical plant is outstanding, right? All these sort of, they're tangibles, right? But they're intangibles, we're not talking in accounting speak. I'm just saying that how do you value those components of the business as you go into a process? Because I think we're at the stage now, because of so much strategic activity, where it's not just about EBITDA, right? It's not just about a multiple of of this bottom line cash flow number, which is really like sort of been the peg that we've used for everything for so many years. It's becoming a little bit more about, well, what about this other stuff? I mean, can you speak to that at all in terms of like how you go to the market with that?
Yeah, I mean, I think in terms of buyer interest, those are definitely key aspects. Whether you have some sort of differentiating program, I mean, I think of some sort of, whether it's joint ventures you have with local hospitals, maybe hospital at home. I'm thinking some of these other outside the box programs, things that can drum up buyer interest. This, especially from a strategic, there are going to be buyers out there who are looking for, whether it's they're looking in your area, and they want to penetrating that market area, or it's just the maybe holistically, it's not only that market area, but it's what you're bringing to the table in different programs. I would say that certainly adds value. I think everything is always boiled down to multiples of EBITDA, right? When we're, especially from a strategic, any kind of buyer, looking at how quickly do I, make my money back on this, and when does this start earning, really making money for us? It's looked that way, but one way of where there might be some unfavorable results in terms of whether it's diligence or just trends. Having those differentiating factors can help kind of solidify what you're looking for in terms of a return on your company. So I'd say it's more used as maybe almost a leverage point, and saying keeping the numbers in the range that you want to keep them in, is it's important to have those differentiating factors, and that's where we see it leveraged a lot of times on the sell side is calling those out and really helping identify that for any strategic buyers.
Yeah, I wish there was a way of doing that accretion analysis where you could say this is worth this much.
Yeah.
Just personnel, right?
Yeah.
Caregivers, right? Just that piece alone. What's
Well, I
the
mean, now, yeah, caregivers. I mean, and that's kind of that's one of those that caregivers, obviously, we know is a huge value add now, just having them. So even
yeah.
if they're, for whatever, like, I mean, we've seen buyers where there's opportunity in the company because their caregivers are, maybe their productivity levels are low, and knowing
hmm
the strategic buyer, they're going to up those. It's always a recommendation of ours. We don't want, that doesn't mean go in and expect higher productivity, so then you lay off people. It's have expect to grow, increase productivity and then grow within the caregivers you have, because there's such a commodity now that, it's almost worth having as a provider, having lower productivity. And it's almost worth it because that's just value add for a buyer. They're just, because if they can come in and change that productivity, they can now take on higher volume without adding cost. I mean, that's a win-win. So it's definitely something to call out, is if like, hey, listen, we have lower productivity, we think we can get it higher, which just means we can take on more. That can certainly add value.
Yeah, we've definitely been in that scenario where a larger strategic looks at a deal and we tell them, this ownership's been in place for decades. There's some individuals within the organization that may not be pulling their weight, right? And there may be, whether it's in the SG&A, in the sort of the salary capacity, or whether it's, in the caregiver capacity. There's also maybe a lack of technology or logistics, where when you come in and you overlay this and you make the changes that you need to make, this is really what you're going to be looking at in terms
Well,
of this business, right?
and that's a great point, and something that calls back to your question about the kind of the value add of that broker dealer is, these deals we go in where you have a non-represented company. I mean, management act backs aren't a thing, right? They don't think
Mm-hmm.
about the personal expenses they're flushing through the company. They don't think about, well, I'm paying myself and my husband doesn't really do anything out of the company, those sort of things. And I can tell you, if those aren't obvious in diligence, if you don't have a line where it's obvious, 20,000 in personal travel or something, where we do identify non-recurring expenses and we'll pull out what we can identify, but we're certainly not combing the general ledger for every single instance. Having a broker dealer to help flesh out those management add backs, not only the low hanging fruit, personal expenses, ownership, owner reimburse owner compensation, but also pulling out the strategic management add backs of, hey, listen, there's synergy. We know you have synergies for these positions, and we think that this is a valid add back to EBITDA, because it's a value you're going to recognize on day one. That's where your team helps as well. And then it's on the diligence team. It's on my team from the buy side to validate those ad backs and
Right.
say and either accept or reject them and say what we think is worth it.
Look, I think that's a good place to conclude, because really what our hope when we go into a process is that either we're going in with your team, having done the financial preparation, that analysis, identifying any aspects to the books and records that we may not be familiar with, that might hurt us in process, understanding the clinical, that and the healthcare laws and where those risk factors are. And then, ideally, if we go in with a team like yours, we also have a team like yours on the other side of the deal. Albeit, would probably have to be a different firm from a conflicting standpoint. But then we're dealing with problem solvers on the other side of it. And I think that in that regard, we could go on and on about how we can serve our clients, and how clients should really talk to us prior to even as they're even contemplating, hey, what's my value, what does a process entail, what are the ways to capitalize my business, if there's shortages there. And I think those are just conversations we enjoy having. I know you do. And I will just say that when we work together on these transactions, whether we're on the same side of the table or opposite each other, it turns the outcomes are much more favorable for all parties. So look, Mark, I appreciate it. I don't know if there were any last thoughts you had here.
No, I mean, I feel like we like you made the point. I could talk all day about this and why it's important. why both are important. I really love where we're moving in sell side. Doing your sell side diligence in sub capacity, is just super important. Too many times do I see just buyer and seller expectations not align because of what's found in diligence. And if you can just get ahead of that, if you know what you're getting into, it's just going to be a smoother and probably most likely more successful process. So I really like where this is going in terms of pushing for these sell side type, and I just think having that representation as well on the sell side is just a significantly added benefit to not only get you the most for your money, but also or the most for your company, but also to ensure success in the whole process.
That's great. All right. Well, Mark, thank you very much, and we'll be in touch.
Yeah, no, absolutely. Thanks. Great to be here.
All right. Take care.